Okay, so this is my investments presentation. We're going to look at my portfolio and the outlook of the economy to start off. See, GDP has been on the rise continuously since 2010, and unemployment is hovering around a healthy 4% and is actually the lowest it has been in 50 years. So those are good signs for an economic outlook. Also inflation. The inflation rate has been a little bit above and a little bit below 2%, which economists suspect economists usually say that that's a healthy inflation rate. One lagging indicator is corporate profits. Usually corporate profits correspond with high corporate profits usually correspond with a healthy economy. And as far as a leading indicator, stock prices, when stock prices are higher, it means that companies are usually issuing more stock, and that is in anticipation of them doing well. So my market hypothesis is semi-strong. I believe that all the information that is available to the public is used when investors are making choices, and but if investors did have information that wasn't available to the public, then they would have an advantage over other investors. My risk tolerance was that of a 28. It's not above average, but it's hovering right at that mark where it could be almost considered above average because it's above average. For my portfolio, the plan is to increase the value from 100,000 to 130,000. I have a 4-year time horizon, and that's when my bonds mature. And my average yearly return will be around 13.33%. As far as the short-term outlook of the economy, I think the consumer industry is going to be doing well. As you can see, unemployment is lowering, wages are rising, and as more people get jobs and they make more money, they are going to continue to spend more. My long-term outlook, I think the courier industry is going to be doing well. Amazon, which is a part of the courier industry, has benefited greatly from e-commerce and people purchasing products online and having them delivered directly to their house. And as retail struggles, online retailers are doing very well, and I anticipate more and more people to be ordering their products online and having them delivered directly to their houses. For my first stock, I will be investing into Best Buy. It is currently priced at $72.67. Its return on assets, it had a very bad year in 2012, but since then has been rising. And its return on investments is much better than the industry average, as you can see right here. One catalyst for Best Buy to start be doing well is their new CEO, Corey Berry. She's been with the company for 20 years, and she's very big into strategic planning and such. And as the retail industry becomes more competitive, they're going to need to be more strategic with their decisions. My holding period return is an anticipated 18.47% for that Best Buy stock. For my second stock, I'm going to be investing in Newmont Gold Corporation. its net margins are far greater than the industry average. As you can see right here, it's 25.42% to the industry average of 16.15. Its price earnings ratio is over 6 times that of the industry average at 146.41% to the industry's 20.77. And its return on investments is increasing drastically, as you can see in this graph right here that I made. Its dividend yields from 2017 to 2018 nearly quadrupled from 67 cents to $2.15. A catalyst for this, as new tech, it's making gold easier, safer, and more efficient to mine, and usually takes gold mines around 10 to 20 years to start profiting, and I think we're at that time about right now. And as the tech makes it easier and more efficient, the price of gold usually stays the same, and that just means more profits for Newmont. My holding period return is around 12.46%. For my bonds that I'm going to invest in is the Walt Disney Company bond, which is currently priced at $104.70. It's got an investment grade of A from Standard & Poor's. It is in over $50 billion worth of debt, but that could be due to a lot of investment that Disney has been doing recently. Its coupon is 4% fixed, pays $2.09 semi-annually. Matures in 4 years, like I said. For my goal, my portfolio, I want to be done in 4 years. Bond prices will rise if the interest rates fall below 4%, as the coupon is more enticing to investors, and the bond price will fall if the interest rates rise above 4%, because it's more incentive for the investor to invest into something else that pays a higher coupon. My other bond that I'm going to be investing in is Amazon. Currently priced at $116.66. It's also an investment grade A- from Standard & Poor's. Nearly $60 billion in debt, but that's due to a lot of investment as well. Matures in 4 years, so the bond maturity matches my Disney Corporation bond. Coupon of 5.2%. It pays $3.30 semi-annually. Just like with the Disney bond, the bond price will rise if interest rates fall below that, as the bond becomes more lucrative, and the bond price is going to fall if interest rates rise above that, as the interest rate is more enticing to investors versus the coupon rate. For one of my funds, the paid-on corporate bond fund, it has a minimal investment of $5,000 with a 14.31% return. It's in the 39th percentile rank. As you can see, the Sharpe ratio is 133 and standard deviation is 3.64, with a fund expense of 0.065%. And then the PIA Triple B Bond Fund, which invests into all Triple B bond grades. Minimum investment of $1,000 with a 16.3% return. It's in the 2 percentile rank, which is really good. The Sharpe ratio is 1.27 with a standard deviation of 3.8. And the fund expense, which is extremely low, of 0.017%. Now, how I'm going to turn this over, I'm going to put $10,000 into Best Buy, which is around 137 shares, which is 137 shares. You got a 4-year average return of 10%, and I'm going to sell if it drops lower to that for 6 consecutive months. With average returns of $1,000 each year, it's $4,000 by the end of 4 years. And then I got $20,000 invested in the Newmont Gold, which is around 488 shares. 4-year average return of 8%. And I'm also going to sell if it drops lower than that for 6 consecutive months. That's $1,600 each year, totaling $6,400 at the end of 4 years. For my bond turnovers, I'm going to put $20,000 in Disney bonds, which is 191 bonds. The coupon at 4%. I'm going to sell if the market rate remains below for more than 6 months. The future value 4 years from now would be $23,200, and my gain from that would be $3,200. And then I'm going to put $15,000 into Amazon, which is 90 bonds, with that 5.2% coupon. The future value 4 years from now is $18,128, and that's a $3,128 gain from that bond. And then for my funds, I'm going to put $10,000 in the Payton Corporation Fund. When you factor in the math of the return and the expense, I will eventually be getting at the end of 4 years $2,262. And then I'm going to put $25,000 in the Triple B bond fund. When you do the math on that, after 4 years, I'll get back $11,450. And if you add all of those numbers up, I get a total return for my portfolio after 4 years of $30,440, which is, sorry about that, which is 440 more than what my goal was for my portfolio. So there's my works cited. Thank you.